Welcome back, guys. In this video we're going to talk about how to catch sniper entry. All those huge risk to reward trade you just see on Twitter. That's what we're going to be discussing, and somewhere at the end of this video I'm going to talk about how to stack positions, right? So if you want to be able to flip accounts or grow your small account aggressively, is by stacking positions. That's how I'm able to do all these crazy account flips. So we're going to be discussing all these things in this video. So if this sounds like something you're interested in, be sure to do me a favor and hit that like button and also subscribe to the channel. So let's get into it. Now what you're looking at on the screen is actually a trade that I called in my private group, where this is actually a 26-hour trade. And how do we catch this trade? This is the basic logic of sniper entry, is zone refinement, your ability to refine zones. What you're looking at here is nested zones, right? And the product of this kind of trade is the result of this kind of trade is a product of clear directional bias and zone refinement. I'm going to explain all these things now. So for you to catch this kind of huge clean risk to reward trade that is not going to give you headache, that's going to go straight to your take profit, you need to, the first thing you need to do is to determine your directional bias. Now depending on the time frame you're working with, um depending on the time frame you're working with, that's that's what will determine the time frame you use for to find your directional bias. Now I want you guys to take note of this time frame alignment. Just write it down. If you are working with the daily time frame, your as your higher time frame, your intermediate time frame will be the 1 hour, and your lower time frame will be the 5 minutes. If you're working with the monthly, your as your higher time frame, your intermediate time frame will be the daily, and your lower time frame will be the 1 hour. So let's make this a monthly, daily 1 hour, weekly 4 hours 15 minutes, uh, daily 1 hour 5 minutes, 4 hours 15 minutes, 1 minute, so and so on. So just depending on the time frame you're working with, pick your time frame. Now since this is our 1 hour time frame, this is actually our intermediate time frame. We have to go up to our 1 hour higher time frame, which is the daily, to find our directional bias. So why do I take this trade now? First of all, we had a clear directional bias. What do we have here? We actually have price. Its price, you can see that price actually break this structure. Price is bullish, so we had the market structure shift after price break this low. And now what the price did, their price formed some kind of structural liquidity and then come back up and take out that structural liquidity after multiple inducement around here. Well, let me set this up. I'm coming. After multiple inducement around here, price came and take this structural liquidity and tap into this our order block. So as it tap into our order block, what am I expecting? Because we have changed structure here, this whole thing was a retracement. This whole thing was after we switched structure at this point. This whole thing, I was expecting a retracement for price to continue to downside and take out this low right here. So now this low is actually our long term or higher time frame drawn liquidity. This is where we are expecting price to break into. I'm still bearish and I'm waiting for price to break into here. So but immediately price tapped into this place. Remember, I'm expecting bearish move, so immediate price tap into this place. What I have to do is to jump into my intermediate time frame to see a market structure shift to confirm that price can react off of this level here. So on the 1 hour time frame, what do I see here now? The 1 hour time frame, what happened here? This is at our key level. So on the 1 hour time frame, we had a market structure shift, and it's something I told you guys that it becomes even high probability when it breaks both the last higher low and the prior higher low. So in this case, it's a very strong market structure shift, right? So now immediately I saw this, I know the trend is bearish. I know we have now that this price is reacting off of this key level, and the next draw on liquidity is this our higher time frame draw on liquidity. So what do I start doing? I start looking for bearish setup using the concept of structure, liquidity, and POI. After our break of structure, we have our liquidity sitting right here. After we have this liquidity sitting right here, now we have this other block that is right here. So this was where I was expecting price to trade to this place, and I set my limit order at this point, and my take profit was this low because of, remember, the normal market structure, right? We have low, low, high, low, high, break, market structure shift, this thing like this, and the, yeah. So we are expecting price to break this low right here. That's what I was expecting. So I set my take profit at this zone. But unfortunately, this was a trade I called in the, I don't know whether I called this in the free Telegram channel. I don't think. I think it's my only my private group. Right. So after we saw this thing, after but so this was a missed trade, right? So but we keep following the trend, we keep looking for our market structure shift, our structural liquidity and POI setup in bearish ones because our drawn liquidity have not yet been taken. So what do we have here now? After we did this and we had a double break of structure, price break this one and break this one. Okay, let me get rid of this double break of structure, let it not be confusing. But basically we have a break of structure, which is the break of the last lower low. Alright, so after price break that structure, price came and retraced and then break structure. So we had our structure. The next thing we want to do is to mark our liquidity, and we had this liquidity at this up zone. Next is our POI. This is the only POI that is valid because of if there's any breaker block is already mitigated, it's useless. The only POI here is valid. So I now mark my zone at this point. Now pay attention to this. After I mark my zone at this point, I would have just take I actually I the reason why I would have just take my entry at this point, first entry at this point, and this is actually a nice this thing. I would have take it and not start looking for lower, more refined entry. I would have take it. The main reason why I didn't take it is because of I didn't trust this zone actually. Why? Because of there's no a clear order block here, and this looks like if this order block have been mitigated and we have a clear liquidity here. This is the reason why I did not take it. But this is the setup you want to take. This is the setup that based on our strategy we are expecting to take. So now what you can do if you want to refine your entry and make it more smaller is as price tap into that your entry, this is where you're looking to enter. As price tap into that your entry, instead of you taking a trade from there, you will go down to the lower time frame, and what you'll be expecting in that lower time frame is your normal structural liquidity and POI. So you're expecting price to do that thing indeed, break of structure, then structure. So you're expecting this type of thing in your lower time frame inside this point of interest. So you can now take your entry at this point and you will now have that tighter stop loss. I will explain this thing with a schematic diagram as I finish progressing once again so you guys can understand. So since this our POI is a 1 hour time frame and want to scale to a lower time frame, which one time frame are we going to use? Are we going to use the 5 minutes time frame? Remember I told you monthly, daily, 1 hour, 5 minutes, 15 seconds. You see the ratio, the scaling. We also have weekly, 4 hours, 15 minutes, 1 minute. You see it. And also we have yeah, basically that's it. So these are 1 hour. The next lower time frame we need to scale down to is the 5 minutes time frame. Now on the 5 minutes time frame, we want to go back to we want to go back to that our zone. That our zone we are interested in. So now this is that our zone we are interested in. As price tapped into that our zone, we are expecting a structure shift, and we actually got it. The same thing that I told you about a structure shift. What do we get? Higher high, higher low, higher high, higher low, higher high, and then what the price did, it breaks the previous higher low and also break this one low at this point. When price did this thing, we have a market structure shift, and it has showed that price is respecting this level. So what else are we looking for? We have gotten our structure. We now want to see our liquidity. So this is where our liquidity was. So after we got this thing, we have gotten our structure, our liquidity. Now we look for the key level to trade from, and this is the only clear level that is closest to the liquidity, which is this other block. So I marked it out. Now what I did is to take my entry and put my stop loss at this one high. Notice something, not at this one high, because we have refined it at this one high. So now we now start looking to take our entry at this point. So that's how we took this trade. That's huge. And then we are still going to target our normal draw on liquidity, which is the intermediate time frame. Let's go back to the 1 hour time frame. After price retraced all this place, now we have a break of structure. This is the next break of structure we're expecting. So in this case, this is our intermediate time frame draw on liquidity, or that's where price is expecting to draw. We still have a higher time frame draw on liquidity here, but let's just focus on our intermediate time frame, and we can actually hold this trade all the way to this place. But this is so huge and I'm not interested in it. So that's it. So we are going to hold this trade all the way down to this point. Now let's go back to our 5 minutes time frame. and talk about scaling, right? Scaling positions in. Let's talk about scaling into positions. Now, after we took our first trade, why this first trade is still running in profit? Why this first trade is still running in profit? We start looking for, let's pin this. We start looking for more structural liquidity and POI setups. We start looking for more structural liquidity and POI setups. So basically, what we're looking for is um, something like this. Something like this we are looking for. Then we take our entry at this point. We take another entry at this point. Then we expect price to do something like this. Let's say it breaks. We expect price to do something like this. Maybe let's say it forms something like this. Break. Take the second entry. Then price, let's say price does something like this. We take another entry, and let's say price does something like this. We take the next entry. So this is basically what we are expecting. Right, so we keep on taking this entry. So this is our first entry at this point. Structure, break of structure, liquidity and POI. Structure, liquidity and POI. Structure, structure, liquidity and POI. Right. Let's mark all these things. We have structure, liquidity. In this case, our POI will be the breaker block because of its close. So we're going to keep doing this thing until price hits our take profit. This is our main trade take profit. And by the time you keep on doing these things now, you will see that the amount of money you're going to make will be so huge because of your scaling in. And there are two ways to scaling. They have the aggressive scaling in and the um, more you find an English word that is you see an antonym for it. But basically, I get what I'm saying. And the aggressive word is the simple way. You just to keep scaling with maybe the same percentage. Be in each trade you keep on adding extra 1% or extra 10%. That's an easy way to do it. But the next one and a more difficult way, a more aggressive way to do it is to take all the money you have made from this, all the running profit, and invest it in the next trade. Then you take all the running profit from all this main trade and this one trade and invest it in the next trade. Take all the running profits from these two, this trade, this main trade, this one, and invest it in this one trade. So this one will give you huge money. This way you see those people that always do, they'll take $10 and flip it all the way to 10K in a single setup. But these ones are usually very risky because of price can come up. In most cases, it's very difficult to determine when price is going to give you a straight move downwards. It's difficult to determine it. So sometimes price might just come after give you this entry. You have huge in profit will come and clear some liquidity and continue to the downside. So by the time it does this thing, it has already liquidated all your position. But this is actually a way to do it if you can confirm a very clear direction that price is going to go, and price is not going to waste time planning more liquidity, then you can go by that. So this is basically what we are going to keep looking for: structural liquidity and POI, structural liquidity and POI. Now let's try to, should I hide this? Let's hide this and so you can be clear for it. So as I'm telling you, after we took the first trade from here, so we are looking for structural liquidity and POI. We are looking for structural liquidity and POI setup. So we broke a structure at this point. I want to show you guys also losses so you guys can be. So after we broke a structure at this point, we have this liquidity, we have structure, we have our liquidity. So this liquidity is closest to this breaker block. This breaker block, right? Which one should we choose? Let's just take this one. So this was a trade that I will actually take a loss from. So this is a loss, that the first loss we have. Then the next one we had is a break of structure at this point. The liquidity, do we have liquidity? We have structural liquidity. Is it, have we mitigated this other block? Okay, it's already mitigated this other block. So there's nothing here to take again. This place has been rebalanced clearly. So what do we have here? We actually have structure, break of structure. We have Okay, we didn't. We have liquidity. Then we have our POY. If you go to the lower time frame, you can see this POY is clear. But this case, we didn't come up enough to trigger this one. So notice something. We are stacking in position. We after the main position from this place, we take the next one. This one was a loss too. Then we take the next one. Then if we see another one, what do we have here? We actually have structure, which is this break of structure. Then we have we don't have any structural liquidity. Although some people like to trade inducement, this is when price forms a high to fake trader that is to traders to make traders think that it has start is ready to start going to the other side. So what traders will do is they're going to buy at this point. So this is called an inducement. You're going to buy at this point. So this is actually liquidity. But I don't usually trade this kind of inducement. And if I want to trade this inducement, I want to see it go down a little bit. So, but let's just, for the sake of explaining how to stack position, let's just take it. But I don't usually take it. So after we have our structure, if you're the type of person that trade inducement liquidity, you can decide to call this your inducement. Then where is your POI? This other block, no, it's too far. We actually have a closer one, which is this breaker block to trade from. So this one, they need to actually mitigate it well, but let's just call it for the benefit of that. This is it. So this is actually a missed trade. So notice something how we are stacking positions. We keep on stacking this position till we reach our draw on liquidity. Now, when we reach our draw on liquidity, we need to stop stacking position because of price. We usually retrace. I know price is still going to continue to the downside because we have three time frames stacked. So, but before price continue to the downside, it's usually going to give you retracement. And let's say you continue from this place, you can actually see your structure, liquidity, and POY. What do you have here? We have our structure, break of structure, our liquidity. So you keep on stacking position till you hit your TP and your POY. So this is so the next one we have structure, liquidity, we have our structure right here. Your liquidity at this point and your POY. This was a missed trade. So that's it, and more. We have our structure. You can keep on doing this thing until you get tired. Our liquidity and your POY. This is the closest one to this place. So basically, this is what you're going to take. So notice how many trades we have scored, and we keep on calling this trade till price reach our entry at this point. These are higher time frame draw and liquidity. Best line I will go. Definitely, if I'm stacking position and coming down, I'll stop at my intermediate time frame draw and liquidity. Now, if this thing is confusing for you, let me use a schematic diagram to summarize all this and explain it. But before I summarize all this and I explain it, I want to tell you guys about our mentorship. So my mentorship is actually a personalized coaching, right? So what I usually do, I come up with challenges that will help you guys build capital and learn as you are trading, right? So we started a challenge, and the challenge is to accumulate 200k in profit capital, starting with the smallest profit, right? So starting with the smallest profit, we're going to start with a 5k account, and we're going to try to pass a 5k account, which we have actually did. Okay, I'm going to more on that in a bit. So we're going to try to pass the 5k account, and when we pass the 5k account, we try to make 4% from it. Then that 4% we are going to use it and get a 25k account. Then that from that 25k, we're going to now scale to a try to make 3%. Then that 3% will get us to a 100k account. Yeah, I think that is correct. Yes, to a 100k account. Then from a 100k account to 200 and more than, you're going to make 3% from the 100k and 200 and more than. So this is a challenge I've started in a while for a while, and I started it. I was doing it personally, but I decided to bring it to with my and let my students follow along. I'm going to give you exactly what I'm doing. If I'm taking this, I'm going to buy the same profile with you guys and trade it with you guys. So if I'm taking a trade, I'll tell you guys everything so you can just replicate my result. Right. So we actually started this thing last year, November. That's when I started offering the last quarter of last year. And last quarter we didn't do much. We were able to pass the first 5k. I had to get the second 5k. All these things in proof. Just go to the pin comment in this our Telegram channel I had to buy the next 5k and we passed it. After we now use the money to buy a 25k, and that's where we stopped for that year. Then after the new year started, I decided to start the challenge again, and I actually we started with a 10k account. We passed the 10k account, use the money and get a 50 account k account and pass it. Now I told you guys somewhere around this place, I told you guys that have actually I'm going to give you guys chance to come up. I'm going to give you guys chance to so we are going to start up again. So if you guys want to join, so some people joined the group. After they joined the group, so the challenge, so we started again from a 5k account, and this was, I think this was early February that we started the challenge again, starting with the 5k to accumulate new people. And already you can see so far so good. We have already passed the first 5k account. We took a very nice trade, which we call in the free telegram channel, that passed the account, the 5k account. As you can see, the 5k, this is my own 5k account I bought, and it's already passed, right? You can see we passed it, and also my students are also following along, passing it. So that's it. I'm going to buy the same profile you're buying and replicate your result, give you exactly what I'm doing, so that way you replicate your results. So if that's something that you're interested in, if you want more of a personalized group coaching, the one that you try to make money as you try to make money as you learn. If that's something you're interested in, you can definitely send me a DM on Telegram. Just go to the admin, click on this place, you can see the admin, and send me a DM there, or you can click on the description of the video to send me DM on any of my social. Right, so that's what my mentorship is offering. But if you don't have money for it, you can actually just join the free telegram channel, follow the rules. I posted the rules that you can follow, and try to do the challenges on yourself. You always want to challenge yourself. That's how you make money from trading. Now back to what we are talking about. Now I want to explain, summarize all this thing using a schematic diagram. So for those of you that didn't get what I'm saying, you can actually understand it. Now let's go to the daily time frame. So let's say this is what I'm trying to say. You have your higher time frame now. You have your higher time frame. Let's say your higher time frame is bearish. High, low, break of structure. High, low, break of structure. Then we have something like this. Then we have a break of structure. Then price retrace at this point. So what are we expect? We had a break of structure. After a break of structure, what do you have? You're expecting a retracement and the next break of structure. So after price break this, and after we got this retracement and price tap into this place, we are expecting price to react off of this level, right? So when price react off of this level, what we're expecting is price to take out this liquidity right here. After I take out this liquidity, it will tap into this demand, this supply order block, and then take out this one external range liquidity, and thus giving us our next break of structure. This is what we are expecting. Right, so we are anticipating this next leg of price. But after price tap into this place, what we are going to now do, this is our higher time frame. Let's call it the daily time frame. So what we are going to do as price tap into this is to now jump. Let's type this out. This is our higher time frame. In this case, let's call it the daily time frame. Now what we are going to do is to now jump to our intermediate time frame, which will be the, since we are working with the daily time frame, it will be the 1 hour time frame, right? To be the 1 hour time frame. So what we are looking for in the 1 hour time frame is a market structure shift. As far as retracing all this will look like in the lower time frame. This will look like something like this. This is how this one will look like in the lower time frame. So what we have here is, as price break the last lower high, we have a market structure shift. Then let's say we have some form of structural liquidity. Now again, you see this is nested this time. So again, we are expecting price to trade to this other block, take out this liquidity, and trade to this other block. So as price take out this liquidity inside this zone, once again inside this zone, let's just zoom out. Once again inside this zone, let's try to zoom out a bit. You will now go into your lower time frame, and what you're expecting is that same entry. Now remember, this is your long-term drawn liquidity. Right, let's mark it as let's make it 3. This is your long-term drawn liquidity right here. This is your long-term drawn liquidity. Now let's zoom out a bit. As price tap into this place, what are you have having our market structure shift at this zone. So as price tap into this this place, swap this liquidity and tap into the other block, what are we expecting? We're expecting price to reverse and break this structure at this point, forming as our next break of structure. Like this is what we are expecting, right? So we are yet to see this price. So inside this place, so this place becomes our what? Our intermediate time frame draw on liquidity. So we are expecting price to react from this place and continue to the downside, right? That's what we are expecting. So now what are we going to do now? In the lower time frame now, we are going to go to our lower time frame. Basically, what we are going to look for is for market structure shift in the lower time frame. So this is how this thing will now look. This is our high time frame was the daily, our intermediate time frame was the 1 hour. Then our lower time frame will be the 5 minutes. So in the 5 minutes, this is how this thing will look like. This bullish leg of price will look like price forming bullish market structure, higher highs and higher lows, higher highs, higher lows, higher highs, higher lows, then higher high, then price does something like this, then break the final higher low. So at this point, we have a break of structure. Next, we are looking for some form of structural liquidity that will form. Let's say price form structural liquidity at this point. Then what are we expecting? We are expecting price to come back up here. Okay, let's say it mustn't be the same scenario. Let's say price does something like this. It's still the same thing, but something we have our structural liquidity. So what are we expecting? We're expecting price to come back up, take out this liquidity, then trade to this supply order block, like at this point. So what we're going to have, we're expecting price to come to this point and trade to this place. So we are going to now put our entry at this point. Then our stop loss at the other block high. And then where will be our take profit? There are different take profit. This is our lower time frame draw on liquidity, because this way we're expecting price to break. We're expecting price to do something like this, take out this liquidity and break structure. So this one you have here is our lower time frame draw on liquidity. This one is our intermediate time frame draw on liquidity. And this one down here is our higher time frame draw on liquidity. So personally, if you want to take a distance, you can actually hold all the way down to this place, but I don't trust holding it. You might suffer retracement. So I stick to taking it at the intermediate time frame draw on liquidity. And as you can see now, if you have taken this trade from here now, this was where we expected to take this trade. If you have taken this trade from here, look at the risk to reward. But when you refine it, you get something like this, which is offering 15, 16, nearly 17 hour. So these are you will now take this trade. Now I now told you guys about stacking positions, right? So I told you guys, even after you take this one trade now, let's say this price started trading in your favor. Even after you take this one trade, you'll still be looking for more setup. As you just be following the normal structural liquidity and POY. So you'll be looking for more setup. Let's say now price after this price did something like this, price now come and form some kind of structural liquidity. So what do we have here? We have our breaker structure. Also at this point. Now we now have structural liquidity. So we have structure, we have liquidity. Next is our POY. Which POY should we take? Should we take this other block, or should we take this one other block, this breaker block? Obviously this one, because of its closest to the liquidity. So we take our entry at this point. Now we place our entry again at this point. Stop loss at this point. Take profit at the draw on liquidity at this point. So we see how we are stacking position. So let's say price come down here and trigger you and go like this now. So at this point you have taken two trades. Sometimes you even have multiple trades, two trades that will occur. So then what I talked about stacking, about aggressive stacking, and I don't know what to call the next one, but this not aggressive stacking. So what I talk about is aggressive stacking, that after you take this one trade, as price gives you this movement, there will be running profit. Then you take all the running profit and put it in this one trade. Then if you, after price give you movement and give you the next step setup, you take all the running profit and put it in the next one. So before price trade to this place, you have make huge amount of money. But the problem with this one is that in some cases price is going to come back up, and maybe let's say price might, after it breaks structure at this point now, what price is going to likely do is, as this one is still running in profit, it's going to likely come back up and maybe do something like this. Now traded finally mitigate this other block, create structural liquidity that is used and mitigate this other block, then continue to the downside. So what will happen, since you put all your money back to this one trade, you get liquidated, and this one trade will close at a huge loss, and slowly clearing out the profits from this one. That's why it's better just to risk to stacking more position. So this video has been long, and actually took me time to make this video. These are usually questions that you guys ask in my comment section, or personally my students ask. So if you want me to clarify anything, or you want me to talk about anything, just let me know in the comment section. I will always reply you. And if it's something that I have to do with a video, I will make a video. You guys, we are still small, so it's very easy for me to reply, guys. And guys, as you can see, this video actually took me time and effort to make, so please do me a favor and like the video, also subscribe to the channel, and I will see you guys around.